Good morning, everyone, and thank you very much for joining me. This is the morning market review. It's Wednesday, it's the 30th of August. My name is Russell Shaw. I'm a senior market specialist at FXCM, and I'd like to highlight my email address, rshaw@fxcm.com. So if you'd like to correspond, that's the email address to use. Just going to go ahead and bring up the disclaimers. I'll start off with our high risk investment warning. Good morning, Kim and James and Raj. Pleasure to have you on the webinar. Thank you very much for signing in and joining. It's much appreciated. Thank you everyone for signing in this morning. All right, let's just take a look at the market commentaries disclaimer. And just our references, MarketScope 2.0 and TradingView.com. I want to bring up the dollar. So we see the resistance still at work here. I tell you, the price action at this particular level, again, I'm finding quite challenging. If we take a look at the hourly of the US dollar yesterday, you saw that we actually had a very nice sort of setup here for a swing. And we had the two triggers. And then the next condition is that we have to see the momentum. And the momentum is represented by stochastic maintaining in the upper quintile for an upswing and in the lower quintile for a downswing. It didn't hit that. It sort of touched the 80 and dropped down. And the reason for that is because the job openings, the JOLTS data, came out softer than expected. It came out at 8.83 million job openings, and 9.49 were expected. And I just want to show you the JOLTS chart. Let me bring that up here. And this is an indication of the cooling off of the jobs market. And what we can do is we can put in a trend line there just to measure the trend. We should make this logarithmic. Yeah. Okay. And it's actually accelerated to the downside. So the jobs opening certainly cooling off. So when we talk about a tight jobs market, it's certainly still tight, but it is showing signs of softening. And we've got the non-farm payrolls tomorrow. Sorry, not tomorrow, on Friday. And by the way, we're going to have a live trade on that. Let me just get the link. Let me get the link for that. I'll put that in the Q&A. All right, I've just popped the link in. So join me for the live trade on Friday for non-farm payrolls. Amia, morning to you. There's so many news items which makes trading tough. Trading is tough. You know, I think a lot of people approach the market thinking that it's easier. It's not. Trading attracts the brightest minds in the finance industry. You've got PhDs, you've got MBAs, you've got CFAs, and that's who we compete against. It's absolutely a challenge. In my opinion, that's the appeal of trading, is you really testing your mettle. I think the way to sort of sift through the data is to kind of try and figure out what's the overarching theme of the day. And the overarching theme of the day is yields. Okay, it's yields. We've been looking at the real yield for a number of webinars now. And the real yield is linked to Fed policy and whether they're going to keep rates high for longer or higher for longer. And if there is any sort of news flow that would suggest a change up in the real yield, well, that's important. And the idea here is, well, the jobs market is tight. If you go back to the Jackson Hole speech last Friday, what the Fed chair, I felt that he came out with a hawkish delivery. And what he said was growth, the growth of an economy, if it's above trend, that can exacerbate inflation. That's what the Fed's fighting. It's fighting inflation. And that's what's driving markets, represented by real yields, right? The tight jobs market. Theoretically, if the Fed was if it was restrictive in terms of its monetary policy, then you would expect the GDP to be slowing. It's not. You'd expect the jobs data to be weakening. It's generally not, although now we have seen it coming through on the jolt side, and we'll see if it comes through on the it will come through to the non-farm payrolls. We'll see what happens with the non-farm payrolls on Friday. I think the expectations are for about 170,000, so some softening there as well. If the Fed is hawkish, what does that mean for the US dollar? Well, it would generally be supportive of the US dollar, yeah, because the higher interest rates would put some sort of a platform underneath the dollar. It would mean that there'd be headwinds for the stock markets. Now, if you've got jobs data starting to weaken, well, go and take a look at the yields, see what's happening in the yields. So you go through to US 10-year. I like looking at the real yield, so we go through to US 10-year minus break even. This is real yields, also called TIPS. If you guys have ever heard of the TIPS, Treasury, I'm just trying to remember, it's Treasury inflation protected securities, I think. All right, and let's just go through to the daily chart, see what happened on the real yield yesterday. And the idea here is to really understand the fundamentals. I've always suggested that I'm a technical analyst through and through, but I respect the fundamentals. And I think that if you understand the technicals with the fundamentals, it just really puts you on a much better footing than if you're only looking at technicals. So we do really try and stress some fundamental setups in the webinar. And you can see here's the real yield coming down. Here's the real yield coming down. Well, let's put the US dollar underneath that. Okay, let's put the US dollar underneath that. Okay, and here's the dollar coming down as well. Now you've got the real yield creeping up, or you've got the dollar creeping up as well. The next big data, just to understand what else is important for this week. Inflation data. Inflation data is going to come out tomorrow, coming out at 2:30 p.m. ZA, 1:30 p.m. UK. That's big, okay? That's big. You've got to be very careful with it when it comes to inflation data. That's really sort of the story, isn't it? The Fed is fighting inflation. Also, we're going to get GDP data out today. It's just preliminary GDP data, but if it's coming in higher than trend, well, what does that mean for us as traders? Remember, the Fed chair told us on Friday, growth higher than trend can exacerbate inflation. Okay, so these are the pieces of the puzzle that we're dealing with. All right, so you can see that let's line up the fundamentals with the technicals. Again, I would agree. Trading's the hardest money you'll make, right? We are at a resistance level. That resistance level is at the moment packed with action. We see a softening in the jobs data. What happens if GDP comes in higher than expected? Well, it's expected to come in at 2.4%. I would expect it to come in at 2.4%. And if it comes in at 2.4%, I would think that's priced into the market. But if it comes up higher, that's probably going to put headwinds on the dollar. Why will it put headwinds on the dollar? Because the Fed chair told us on Friday, it might exacerbate inflation. And if it exacerbates inflation, they've got to be more hawkish with their policy, higher for longer. So that's the idea of what we're dealing with at the moment. Then we'll take a look at, let's take a look at PCE, core PCE. So this is going to come out tomorrow. Instead of taking a look at the real yield here, let's put in core PCE. I think it's this one. Yeah. And you can see that the PCE also showing signs of moderation. So, okay, if it continues to show signs of moderation, if the job market continues to weaken, GDP comes in at 2.4%. What does that generally mean? I think it suggests that the transmission mechanism of the interest rate hikes is now starting to work. What happens is the Fed imposes or implements interest rate hikes, and then it takes months for the interest rate hikes to move through the transmission mechanism and effectively affect the economy. And what we're starting to see here is potentially where the Fed wants us to go. What have we got to do? We've got to track real yields. So let's go back to the real yields. Okay, and what we've got to do is we've got to see if the real yield continues with its higher trough followed by higher peak. If it comes down like this, okay, it should bring dollar down with it, but if it shoots up like that, it should take US dollar up with it as well. What you can do is you can put in, say, US dollar underneath, and you can see that generally it's putting US dollar up with it. We can put in gold underneath it. If dollar is moving up, what should be happening to gold? Gold should be softening, right? Let's take a look. Okay, interestingly, that the movement down in the real yield starting to push dollar down. Here's the red candlestick starting to push gold up. Okay, so and then let's just take a look at one more chart with the real rate. Let's put Nasdaq underneath. Okay, let's put Nasdaq 100 underneath. Okay, very much like gold, pushing down, and then with the softening here of the real yield, we're getting dollar pushing down, and we're getting gold pushing up. We're getting Nasdaq being supported as well. So keeping an eye on yields, tying it into the fundamentals, specifically at this stage, monetary policy. The idea here, I think we would be batting on a better wicket. All right, so let's just take a look at yesterday. So what happened was the JOLTS data came in, and we just got slammed. The US dollar just got slammed. But let's just top-down analysis here. So yesterday we said we're missing data. We don't have a trend with the US dollar. It's just moving sideways. Again, by the way, Kim, that's adding to the exasperation, so to speak, of trading. It's much easier to trade a trend than it is to trade a sideways pattern. And with dollar moving sideways, well, that's a big instrument moving sideways. So let's just go through here. Peak, trough. Okay, let's go through to US dollar. All right, now something interesting's happened here. It's dropped from zone 1 into zone 2, so we do have some relative weakness here. What I would potentially be looking for is for the US dollar to move back into some sort of trend, either to go into zone 1 or into zone 3. But the fact that we've fallen into no man's land, again, unfortunately, that means the buzzword is patience. Let's go through to the hourly, and there does seem to be a bid at the moment with the US dollar. It does look as if it's crossing back up. It does look as if the stochastic has crossed back up, and now if it makes it through to the 80 and holds, well, then the dollar's starting to get bid again. What possibly could be causing the dollar to be bid? Well, we still have this uptrend on real rates. Even though the JOLTS data came back yesterday and pushed dollar down, the underlying influence at the moment is this upwards trend. So what would be interesting for real yield is in terms of the way that it actually trends. Does it slow down like this? And if it slows down like this, I would suggest that we would get a softening of the dollar. But this is all hypothesis. The idea here is we're still trending up. We're still trending up with real yield. Okay. The fact that we're still trending up with real yield, to me, means that there is limited downside for US dollar for the time being. There seems to be some sort of support, some sort of underlying floor for the US dollar, simply because the real yield, okay, is quite restrictive at the moment. So the fact that the real yield is restrictive at the moment, I think, provides a headwind for the greenback. A tailwind for the greenback, a headwind for gold, headwind actually for stock market as well. So we just gonna have to keep an eye on this and keep an eye on those individual data points, because if it does point out to a softening in GDP, which I don't think it will, I think we're going to get 2.4. If it does point to a softening in the labor market, then maybe we start seeing a turnaround in the real yield, but we don't see it quite yet trend basis. If there is any questions, go ahead, type those in now. We do have the crypto minute, which I'm going to cross through to in the next few seconds. But if there's any questions, just go ahead and type those in. Best to use the 10-year. The 10-year without the break even, is that what you suggest, James? At the end of the day, what you would do is just, as long as it makes sense, as long as it makes sense and you're comfortable with it, then, you know, I don't see any issue with that. I like looking at the real yield because it gives us a sense of real restriction. All right, let's wrap up here, guys. Let's wrap up here, and we shall go through to the crypto minute. Thanks very much.